Hello and welcome to the Killik and Co market update. Another week, another record high for markets. We've talked about US equities a lot in recent videos, but this week we have been looking at Japanese equities. This week, Japan's ruling party has elected a new leader, a lady called Sanae Takaichi, who will now likely be the country's new prime minister. She is viewed as being very pro-business. Apparently she's a big fan of Margaret Thatcher and she favours low interest rates. The market reacted very positively to her election, with the Nikkei 225 index gaining 4.75% in a single day. Here's a chart showing the percentage gain of the Nikkei 225 index over the last 5 years when measured in Japanese yen. It's up over 100%. However, it is worth noting that the Japanese yen has been very weak over that time, which has negatively impacted returns for overseas investors. Here's the yen against the pound. 5 years ago, 1 yen would buy 0.0073 pounds, and now it will buy less than 0.005 pounds. That's a weakening of over 30%. Here's that Nikkei 225 chart again, but this time showing the returns for a sterling-based investor. This time the gain is less than 30%. The main reason for the change in exchange rates is the respective interest rates in the two countries. If a country has a higher interest rate, its currency will tend to strengthen as more people will want to hold that currency so they can earn the higher interest rate. On here we have the UK base rate in pink and the Japanese interest rate in green. Japan's base rate is far lower, making its currency less attractive and therefore weaker. On the subject of currencies, another area being impacted by currency movements is emerging markets. A lot of emerging market countries tend to borrow money in dollars, and therefore they are adversely impacted when the dollar is strong because it means they have to pay more interest. The dollar has been relatively strong for much of the last decade, and that has been bad news for some emerging market economies. The weakness in the Chinese economy of late has been another factor. On here we have the MSCI Emerging Markets Index in pink, the MSCI World Index in the black, and the S&P 500 in green. On this 5-year chart, you can see the Emerging Markets Index is lagging. However, if we just look at this year to date, the Emerging Markets Index is in the lead with a gain of over 18%, and that's for the sterling-based investor. A key reason is that the dollar has weakened this year. Here it is against the pound, and a weaker dollar tends to make investors more willing to invest in emerging markets. And lastly, there have been a few headlines this week about UK food inflation. Here it is over the last decade. It nearly got to 20% during the COVID era. It then came down, but it has since started rising again, and it's currently 5.1%. This data was actually published last month, but a number of key figures this week in the food industry have been very critical of the government, and they have said that it's government policies, not global pressure, that are causing this food inflation. They're saying that the reasons behind it are the higher minimum wage in the UK, the higher employer national insurance contributions, and the difficult planning laws that make it difficult for farmers to expand capacity. Food prices in the UK are currently 38% higher than they were back in 2020, so we'll be waiting to see if the government has any response to this latest criticism. Moving on to have a look at next week, it's a big one for the banking sector, and we are expecting results out from Goldman Sachs and JP Morgan. That's it from us. Enjoy the weekend, and we'll see you next Friday.